Wow, what an incredible day we just experienced in the US stock market. The S&P 500 was up 2%. Even more remarkable was the small cap Russell 2000 up 5.5%. Its best day in quite some time, and its second best day in 3 whole years. So that puts into perspective how rare a day like today was. There's a lot of enthusiasm around the smaller banks out there. There's also a lot of enthusiasm around interest rate sensitive areas like utilities and REITs and even bonds themselves. A lot of that is driven by interest rate expectations, and interest rate hike expectations dropped significantly after this morning's inflation reading. So that caused a whole flurry of rotation of money within the markets that we'll talk about in tonight's video. We'll also get a sense of what's been going on with sector rotation lately, and then we're going to get into a trade application example where I wanted to concentrate on the utility area with a dividend aristocrat that is bouncing up and off of its rising 30-day moving average and also producing a bullish near-term divergent signal. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 14th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. You'll also see which stocks are giving you overbought and oversold cluster signals at the bottom of those emails. In addition to that, we're heavy users of X, formerly known as Twitter. If you're not doing so already, we would encourage you to follow us. My handle is @BrandonVanZ. We really appreciate those of you that click like and repost with this Market Outlook social media. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And my, oh my, what an amazing day it was. As you can see in front of you, I'm sure most of you are aware by now, but in case you were under a rock, today was one of the best days that we've had all year. Markets up 2% in some cases, and even more than that in the small caps case. But even here with the broader based S&P 500, it was an absolutely spectacular day. Notice that there was very few red patches on the screen, so there's really not much to discuss in terms of negative performers. Do keep in mind that what spurred this rally on today is, as I'm sure most of you are not surprised by, how the market participants are viewing interest rate policy. And we did have an inflation number that was posted this morning before the market opened, and most market participants viewed that number as a significant cooling off of inflation expectations, which then led the market to almost immediately reprice what they thought the interest rate environment was going to be moving forward. So remember, we did have that day not too long ago where we actually touched 5% on the 10-year Treasury yield. Since then, we have not been able to burst through there. In fact, it's kind of acted as a resistance or a lid to interest rates, and interest rates were diving lower once again here today, and that really spurred on certain parts of the market, especially the utilities and the REITs. Notice down below here, keep in mind these are smaller portions of the market naturally, but nonetheless, they had been areas that were really out of favor for quite some time, and today they snapped back in a big, big way. Every single utility and every single REIT in the S&P 500, from what I can tell, were higher today. That does not happen very often, and usually is as a result of what's happening with interest rates, as those two are kind of the most interest rate sensitive areas within the market. So those two in particular caught my eye. Do keep in mind that not all of those more defensive areas fared quite as well. I should also point out real quick that healthcare, while it did close higher today, many of the larger healthcare players were a little bit under the weather there and maybe needed a little bit of healthcare on their own, including Eli Lilly. We've got AbbVie, we've got Merck, we've got United Healthcare. Even Johnson & Johnson, while they were up just fractionally, kind of underperformed the market today. So if there was any kind of pattern of underperformance, I would say healthcare probably stands out a bit more from that perspective. I also found it interesting that the insurance stocks within the financials area had been the strongest area of the market. Guess what? Today it was exactly the opposite. Notice many of those insurance companies closed in the red today. Progressive and Chubb and Travelers and Arthur Gallagher and Marsh & McLennan, many of those in the red today, while a lot of their other financial counterparts in the banks and brokers and things like that had spectacular days. Notice that Bank of America, as just one example, was up 5.5% today. Remember, that's over a $100 billion company we're talking about there. So they weren't alone. We saw of course, Goldman Sachs and Morgan Stanley have really outstanding days as well, up 3 and 4%. So that kind of caught my eye in terms of what wasn't working today. And it's a little bit easier to have your eye spot something like that on a day like today that was so overwhelming otherwise. In terms of the biggest winners, I mean, where do you go with that conversation? Throw a dart. I mean, it was a remarkable day. I would imagine that when we look at the sector 12 grid a little bit later on in the video, we'll find that the utilities and the REITs were right up there with the biggest movers here today. But let's also have a little bit of time to talk about the Magnificent Seven. Of course, they do control a lot of trading activity and capture the imagination of the market a bit more than some of the others. So Microsoft actually underperformed the market today. Again, keep in mind the S&P 500 was up about 2% today. So Microsoft was up, but only 1%. Do keep in mind Microsoft is effectively at all-time highs right now. So you don't want to necessarily throw them under the bus for their underperformance today when the stock market itself is still, a country mile away from its all-time highs. Microsoft already there. Apple also underperformed today. It was down, it was up 1.43%, but underperforming the 2% launch higher of the overall market. Some of you saw my tweet after hours here today. Remember, this is 13F season, so we're going to hear from a lot of the institutions here in the next 24 hours as to what their transactions were for the third quarter ending October 31st. And I found it to be fascinating today with Ray Dalio and Bridgewater in particular. They exited their Apple position and they went into 3M and Best Buy and Abbott Labs and some other dividend stocks. And that was a little bit of a head scratcher because naturally Apple has been a shining star for this market for quite some time, but perhaps their valuations are getting a little stretched, and those that own massive amounts of the shares are starting to question whether now would be a good time to lock in profits and maybe rotate that money into other areas. We shall see. Remember, we haven't heard from Berkshire Hathaway yet. I do not anticipate that we will see that they were selling Apple, as that seems to be kind of one of their forever stocks, at least judging by how they've handled it here in recent quarters and years. But tomorrow after the bell, we will likely hear from Warren Buffett and company to see what they were up to last quarter. And that should be quite interesting, at least to me as a longer-term investor and someone who admires Warren Buffett and his ability to do quite well versus the market over his 70-year history as an investor or whatever it is. But anyway, the reason it may be a little bit more interesting is we had some difficult moments in the third quarter. Right? That would have included October and the end of September, when markets were kind of in a more bearish type of a mood compared to what we've seen here more recently. And so always curious if there are any stocks that have been bludgeoned enough when the market sells off to catch the Oracle of Omaha's eye. My sense is that we're probably not going to see anything major in that regard. We might find a new stock or two, but I doubt he's going to go into it in size because Remember, they did report their earnings at Berkshire here recently, and we've already seen that their cash pile has grown to the largest in history. I think it was like $127 billion. So the chances of them adding a major new position and seeing their cash pile grow to the all-time high is somewhat unlikely. But nonetheless, maybe they were starting to dabble a little bit, and even that will be interesting. So stay tuned to my Twitter feed tomorrow after the bell if you want to be one of the first to be alerted as to what Warren Buffett was buying and selling last quarter. Anyway, Apple today, underperformer, but still a reasonable 1.4% move for a company that's worth, approximately $3 trillion or whatever it is these days. NVIDIA had a nice day as well. Remember, they're one of our Magnificent Seven companies as well. They were up 2% today, and so slightly outperformed the S&P 500, but, that one was kind of what you would refer to as inline. Microsoft and Apple underperformed today. NVIDIA kind of in line basically with what the market itself did. Google, similar to Apple, underperformed here today, rising just 1.34%. Meta, similar to NVIDIA, basically came in line with the market, as did Amazon. They were up about 2.25%, so slightly beating the S&P 500, but not by a major amount. Then there was Tesla. Now, Tesla of these seven companies is probably regarded as the most speculative, and so you're probably going to find much more exaggerated movements both up and down with its shares. Today, definitely in the bullish camp, up 6%, easily outperforming all of the other Magnificent Seven companies and the market at large. So again, kind of hard to know where to go next, simply because pretty much everything, you throw a dart, you found success here today. One thing I did point out in my dividend growth investing class earlier today is that it was the somewhat rare day where dividend stocks were outperforming the general market. Remember, much of 2023, that has not been the case. Now, I identified that maybe 2 or 3 weeks ago. You'll recall in this video when I took a slightly different approach towards my charting routine, and we looked at those ratio charts, and I was showing you how value was starting to break out versus growth, and consumer staples were starting to break out versus consumer discretionary, and a few other ratio charts that gave us some sort of a heads up that there was change afoot. Now, the problem with that is it wasn't a one-sided pivot the way that some market practitioners would want, right? You want the market to react the way that your mind is thinking immediately. And of course, the market is under no expectation to do that for you or for me or for any one individual. And what it seems to me is that we've had a bit of a tug of war internally within the market over the last 2 or 3 weeks, where value versus growth has kind of been going back and forth. Now, keep in mind that for much of 2023, that was not the case. Growth has been trouncing value, and especially the Magnificent Seven dominating the rest of the market from a breadth perspective. So at least there's some life there. Who knows who will win the tug of war in the end? It could very well end up being another major rally out of the Magnificent Seven that leads us to the promised land. Who knows? But at least at this moment, it feels a little different, where those forgotten about areas of the market are at least kind of digging their heels in and making a go of it right now. And today was one of those days where dividend stocks outperformed non-dividend stocks. All right, let's go ahead and take a look at our breadth numbers over on the main part of the platform here. This will be under the Market Watch tab, and you can see that I've got the S&P 500 public watch list pulled up, and there are 469 stocks in the S&P 500 that closed in the green today. Very, very impressive. That is good for approximately 94% of the components in the market, is closing positive. Now remember, that doesn't distinguish whether a stock would have closed higher by 0.02% like Johnson & Johnson, or whether the market or that stock was up like by 6% like Tesla. It just says did the stock close in the green? And today, the answer to that question is yes. 94% of stocks in the S&P 500 closed in the green, which is an overwhelming victory for the bulls. Today probably felt different to a lot of you because it was different. Today was a monumental day. It's not as though we've never seen days like this ever, but just to put it into perspective, you can see that what we accomplished today in the S&P 500 here on chart 6D, we did close higher by 1.91%. That was slightly better than this day over here on November 2nd when we were up by 1.88%. So then that would have to take us back all the way to this candle back here, or this bar, on April 27th, when the S&P 500 was up 1.95%. As you can see with this chart, this goes back 1 year and features the chart each trading day, although I did discover here recently there was a missing day on Thinkorswim. The odd thing is a lot of my students in my class, when I asked them to test it, it was actually on their chart. So why it disappeared from my chart, I don't know. But generally speaking, assuming there's no glitches in the system or what have you, we're looking at basically a full year's worth of trading data in front of us. Just to put this into perspective, notice that this orange line up here has only been touched twice, right there and right there in the last year. Back here on January 6th, we were up 2.28%, and then late last year in November 30th, we were actually up over 3% that day. So that was amazing, right? Some of you may not even remember that candle. I think it's interesting when we're dealing with the markets, and a lot of people think, yeah, I'll definitely remember this day forever. And they will literally forget these days within a year, myself included. We give too much credence to our thought that our ability to remember certain important days will be certain in our heads at that moment. But of course, you roll on a year or two or what have you, and the vast majority of major market movements throughout history, we don't actually remember unless we look it up on Google or a newspaper or something, what was happening that day to cause that. So I find that to be very interesting as well. But last year, late November, we did have one day where we were up 3%. That's the only green bar here where we touched the pink line on the top part. Note that we have not had a single down day in the last year where we've been down 3%. That may be surprising to some as well. Again, this hasn't really felt like a runaway bullish type of a market here recently. And of course, a lot of this is as a result of the market cap weighting of the S&P 500. I have no doubt that if we pull up different indices, we will have different results. But this should put things into perspective that for much of today, we were actually up 2%, had a little bit of a pullback towards the end, so we closed just a little bit less than a 2% gain. But for much of today, it was a 2% gain, and we've really only had 2 other days in an entire year where we could have made that claim, and only one this calendar year, with the big one, as I mentioned before, technically back in 2022. Let's take a look at the IWM. I don't typically do this, and by the way, the VIX fell today. That should not come as a surprise, but just so we can put a bow on it, volatility falls when stocks rise, and that definitely happened today. The VIX is now down at 14. But I wanted to also bring up IWM, because if there was a jaw dropper type of a move today, it was in the small caps. My goodness. I think I was reading on Twitter, it might have been Ian who posted this initially, but he was saying that the outperformance of the Russell 2000 versus the large cap or mega cap Dow Jones, today's outperformance was the biggest one-day outperformance comparing those two indices since going back to, I think it was April of 2020. So we literally would have to go back to when it felt like the world was in a major disaster scenario right there during the COVID wipeout period, since we've seen a day like this for the small caps. I know it's hard for you to read, so I'll make sure I verbalize it here for you just so we're all on the same page. The Russell 2000 was up 5.5% today. That is absolutely bonkers. You'll notice over here, again, to put that into perspective, we were just looking at the S&P 500 a moment ago, and I was talking about how last year in November we had one candle that was up at the pink line, which is the 3% move on this chart. Well, notice we don't have a 4% or a 5% move, not because we couldn't create it, it's just that it rarely comes up into conversation. But today was one of those days where it legitimately would have done that. Truly, truly incredible. Look at this bar. I mean, if that isn't beautiful, I don't know what is. 5.5% to the upside for the small caps. Now, of course, we know the context around that situation. Small caps have been bludgeoned lately. You can see that major downtrend that they were in. So naturally, the further you kick them down, the more rapid they will snap back when there is an excuse or a catalyst to do that. And of course, interest rates were that catalyst here today. But my, oh my, was that an aggressive move. Easily the best day for IWM, the ETF that tracks the Russell 2000, in over a year. This is 1 year. Let's go back 2 years here and see if we've had any day like this in 2 years. And the answer is yes. We did have one other day like this back here in November of last year, but it was slightly more than a year ago, so that's why we didn't see it in that initial view. Technically, it was a year and 4 days ago. We had this massive move on the Russell 2000. So again, back to what I had mentioned before about that tweet that I saw. It was based upon the comparison of the outperformance of the Russell 2000 versus the Dow Jones. I did not say that this was the best day the Russell 2000 has had since April of 2020. I said the difference between the IWM and the DIA, which is the ETF that would track the Dow Jones, the difference between those two was the most stark today. So quite dramatic to say the least. But again, IWM, massive, massive, massive day. Second best day in 2 years. We could take it back even further, just to get a sense of things, 3 years now. And we can also claim that today's move in IWM is the second best day in 3 years. Do I hear 4, right? I know you guys probably grow old of this, but I kind of find this thing, this type of stuff interesting. We can't say it over 4 years. So we can say that today was the second best day for the small caps in 3 years, but we can't say that in 4 years because 4 years would take us back to that crazy period of the COVID wipeout period where we had massive moves lower where the market was down. Can you imagine that? I mean, we lived through that, right? The small caps were down 13% in a single day back here in March of 2020. That is totally insane. But likewise, it is equally as insane that the market was up 9% in a single day. The small caps were back then as well. So we had extreme volatility at that point. You'll notice that if you look at this purple line down here, now again, this is on the IWM, so it's a little bit different than the traditional VIX on the S&P 500, but can still kind of prove that point out, that the implied volatility level on the small caps back in the COVID wipeout period reached 80. Today, it's at 22. And that is somewhat elevated because the small caps have been in a downtrend here lately. So that even makes it more extreme when you think about it from that perspective. So, you know, if you've thought that we've had a lot of volatility lately, it's been nothing like the most extreme moments that we've had even within the last 4 years. But hey, let's have a moment to celebrate. It's been a difficult year in a lot of different categories, including small caps, and today finally was a day in the sun. So I think there's a kind of a collective sigh of relief that the market was breathing out here today. It was a fun day to say the least. Let's get back on track with our more traditional charts now, looking at chart 4B here and seeing what things we can learn from the market forecast indicator. Remember, that is what ultimately drives our conversations in these free Market Outlook YouTube videos. One thing I wanted to bring up, which I was thinking about earlier today, is you'll recall my conversation with you guys on Thursday. I know that there's a lot of content out there, so I know not all of you are going to remember exactly what I'm saying when and all that kind of stuff, because many of you that are watching this free YouTube video are probably watching 12, 13 other free YouTube videos, right? So it's hard to make heads or tails out of who said what and when. But those of you that are pretty regular and loyal supporters of this particular channel and have listened to David and I on it for the last 10 years plus, if you include our time when we worked for TD Ameritrade and produced a similar video, you'll know that we regularly have the conversation of bullish intermediate confirmation signals. And I brought that concept up with you the last time I did this video on Thursday. And I tried to make a point, and I think most of you who listened to me hopefully understood that I was spending a bit more time on it than I normally did, making the point that not only did we have a bullish intermediate confirmation signal, but this was the idealized form of that signal. And I was saying how rare that was, because it felt like in previous months and years, more times than not, when the bullish intermediate confirmation signal showed up, I would tell you how it's the non-idealized form because of either the red line being in the extreme underneath 5 or the blue line not being positioned between 20 and 50. So I wanted to go out of my way on Thursday when I was with you guys to make sure that you were aware that this was actually an idealized form of the bullish intermediate confirmation signal. And as I mentioned on Thursday, and as most of you are aware, that particular signal is a buy the dip signal. And it is very interesting as we look at this today, how the stock market has absolutely rocketed since Thursday. So if any of you had the good fortune of buying the market based upon that bullish intermediate confirmation signal, or any other reason for that matter, congratulations. You have just had an absolutely massive windfall here. So that signal existed on the S&P 500, that signal existed on the Dow Jones Industrial Average, and that signal existed on the NASDAQ Composite. However, it wasn't a clean sweep, because remember, that signal did not exist on the Russell 2000. So just like anything in life, there's never going to be 100% in technical analysis. It's never always as easy as it seems in hindsight or anything like that. But it's just a friendly reminder that when we try to go out of our way to remind you of these different signals that are popping up based upon our experience reading this technical indicator, that sometimes they can be rewarding. Not always, but sometimes, and it's similar to what I had mentioned before when I brought up this bullish cluster signal back here on October 26th as well. Right? I was mentioning during that video that that was the first bullish cluster in over a year for the S&P 500. So had somebody taken the leap of faith to go counter trend on that day based upon that knowledge, you can imagine they have a smile from ear to ear right now when the stock market basically has gone straight up since then. This has been a remarkable move in a very, very short amount of time, with very few down days at all along the way, and tons of epic up moves. I mean, that's what's been interesting about this move off of the lows, is not just that we've had the consistency of positive days versus negative days, it's that many, if not most, of those positive days have been more than 1% advances. Again, we can kind of get that sense if we look at that other chart, 6D. I hate to belabor the point, but I think it's useful to at least acknowledge this, because some people might think this is a normal environment that we find ourselves in, and it's like, no, not really. This is a very extremely bullish environment that we've found ourselves in the midst of. If you look at these green bars right here, when I've got the S&P 500 pulled up, you can see we had a 1% move today. We had a 1% plus move 2 days ago. We had nearly a 1% move on that day right there. It technically closed at 0.94%, but I mean, some of you might be willing to say that was effectively a 1% up day. We had a 1% up day there, we had a 1% up day there, and we had a 1% up day there. So we effectively have had 1, 2, 3, if you want to count that one, 4, 5, 6 days that were up more than 1%, with 2 of them nearly touching 2% in a very short amount of time. This is basically a 2-week window that we're talking about where that has occurred. That's remarkably bullish in that short amount of time. Of course, that doesn't guarantee anything about the future, but it does give us a sense as to how the bulls are not just rolling over at this moment. They are definitely stubborn, and they are ever present at the moment, kind of throwing their weight around, and we couldn't necessarily get away with saying that earlier this year. So this has been really fun to witness if you are on the long side of the market. So naturally, when the S&P 500 is up nearly 2% today, and we've been in strongly bullish posture territory up until today, that means we continue to be with the strongly bullish posture at this moment. Of course, we're above a rising 30-day moving average there as well. Same thing can be said for the Dow Jones. In fact, all four of our charts, you'll notice, including the Russell 2000, now have a green moving average, telling us that price is above not just a regular 30-day moving average, but a rising 30-day moving average, which is generally a bullish feature of the markets. With the other three large cap indices, that's been the case for the better part of the last week and a half. For the Russell 2000, that's new information as of tonight, courtesy of the 5.5% move higher out of the Russell 2000 today. But for the other indices, we've known about it, we've talked about it in these videos, and it continues to be the case. Also with the Dow and the NASDAQ, and really the Russell 2000 as well, and that's another new piece of information today. Notice that the background color of the Russell 2000 chart has changed to that dark green, and so we can now claim that all four of our major U.S. equity indices have strongly bullish market forecast intermediate postures, and all four of them are trading above rising 30-day moving averages. As recently as yesterday, we could not have made that claim. We could have on 3 out of the 4 charts, but it wasn't until today that the Russell 2000 is attempting to play catch-up, and it's doing so in a massive way. Right? This is not just a random throwaway type of a day. This is literally the second best day in 3 years for the Russell 2000. So it was monumental. It basically is dragging the moving average up with it, whether the moving average wants to come up with it or not. Whereas the others, the bullish trends have started to become in place here for the better part of the last couple of weeks. What I would say that is also useful to recognize is that, remember, for a few of those days, we were kind of stalling out right there around the resistance area that I had identified back here in middle of October. The good news is, with 2 out of these last 3 days being aggressive up moves, we've now blown that out of the water. Now we're looking at these prior highs back here at the beginning of September as kind of our next level that we want to shoot for if you want to be bullish. So that's the good news. You know, every one of those resistance points that gets conquered can have the potential of becoming new support in the future. So it's constructive for the markets when you see that type of behavior take place. And that's the case not just on the S&P 500, but it's the case on the Dow Jones as well, where we're well above those mid-October highs. And with the NASDAQ, you can see the same thing, well above those mid-October highs. With the Russell 2000, we're kind of right there, right? Where we ended today is kind of right in that zone. But even there, technically, because we closed effectively at the highs of the day, we did clear that resistance. It's just that it's not as obviously cleared as the other 3 that had a multi-day head start on this whole process right here. But it was a glorious day for the bulls. S&P 500 up 1.91%, Dow Jones up 1.43%, the NASDAQ Composite up 2.37%, so a big day there as well. And then again, the jaw dropper of the day, small cap Russell 2000 up 5.44%. Unbelievable. Put that into context. Remember that it is said that over history, the stock market generally returns between 8 and 10% annualized. So put that into perspective for a second with the Russell 2000 up 5.5% today, almost a year's worth of results in one day. Not quite, but you know, kind of knocking on the door of that possibility there. So wow, big time day. All right, let's pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support us on social media, which many of you have committed to do, and we thank you for that. We appreciate that. It allows us mental justification for taking the 3 hours out of our day to do this video since we don't get paid to do it. So we have to have something to rest our minds upon, and what we've rested our minds upon here right now is knowing that you guys will help support us with our efforts to get the name out about Market Scholars and the work that we do here. So thank you to the 110 of you that clicked like for me on my video when I did it last on Thursday. Let's go ahead and do some shout outs to all of you friendly folks out there. Thank you to Deborah and to Pam and to Terry and Vernon and Eugene and Richie and Joel and Kirk and Ayakipa and Doug and Pam and Evan and Surendhar and Kenneth and Jonathan and Austin and Irene and H. Patel and Julie and El Zhao, and we've got Carl and Michael and William and Norm and Dave and Charlie and John and Nietzsche and Sonia and Steve and Roger and John and Irvin and Valerie. The list goes on and on and on. I can't get to all of you. Nonetheless, I do appreciate each and every one of you, and I hope that every so often you hear your name rattled off in recognition of support. Thank you for doing that, and please do that for David as well. It is appreciated by both of us, I can assure you. All right, as mentioned before, we had a busy day of classes here at Market Scholars with our premium subscribers. And remember, we will be likely launching our Black Friday sale here within another week or so. So if you have wanted to become a premium member, we get access to 10 different classes that David and I teach each week with their own portfolios and strategies and trading plans and all that kind of fun stuff. We would encourage you to at least explore that possibility. So earlier today, I taught my dividend growth investing class, and there we focused on the healthcare sector to add some more exposure in a key name that has multiple decades worth of dividend growth that we still view as being attractively priced. And then David taught his directional option strategies class. I should also mention, I'm sure David has been mentioning this himself as well, but just in case he hasn't, or just in case you only watch my videos and not his, he is making a permanent change to his schedule coming up for the premium members. So he's moving his question and answer session from Saturday to Friday mornings and kind of rearranging a couple of his other classes. So he's still teaching the same classes. He's just doing them in different portions of the week. So be aware of that. And that has been updated on our Trading Rooms calendar if you need to look at that yourself if you're a premium member. All right, let's talk about our sector selector tool. A reminder that this is a couple of days stale by the time I review it with you here in the Tuesday night video. Remember, I don't build this tool for this Tuesday night video. It just gives me something to talk about here. I build it for the Monday morning top-down trend trading class. And there it is perfectly fresh when we review the information. By the time I'm doing this video here on a Tuesday night, now we're a couple of days into the new week. And generally speaking, that's not going to make a huge impact on the rankings of the sectors. But judging by what we saw today, it very well could this time around, because today was such a monumental day. If there is a change in what we see right here, it likely would be an improvement in utilities and REITs, as they were kind of part of that superstar batch here today. Both of them fell week over week on a relative basis from Friday to Friday last week. But again, with their epic resurgence here today, I would not be shocked at all if by the time I'm reviewing this with you a week from today, assuming we get 100 likes and we have the extra time to do so, that we might very well see a slight improvement out of those two. So they're trying to kind of feel their way out, right? We had the utilities spurring to life a couple of weeks ago. We talked about that. That was part of that time period that I had mentioned before, where we were talking about growth versus value and some of the breakout performances in areas that had underperformed, but that we've had this tug of war here in the recent couple of weeks since then. So this is kind of what I was referencing to a degree. Utilities went from second to last to second best. They stayed up there for an additional week, but then last week they fell again. This week, based upon what I know right now on a Tuesday afternoon, assuming that this kind of holds true for the rest of the week, we could very well see utilities popping once again, because today was just a massive, massive day for them on a relative basis. So that's what I'll be on the lookout for when I reproduce this again this upcoming Friday. But there were still important indications sending positive vibes to us, I would say, in general, based upon the readings that we had as of Friday night. We saw financials, technology, communications, and industrials all rising in the rankings in addition to consumer discretionary. Those areas are all what you would refer to as growth-oriented or cyclical, and generally do well if the economy seems to be in reasonably good shape. So even last Friday, before today's epic move in the market, we were getting more of a risk-on type of a feel if you were to interpret what we were recognizing out of the sector rotation that we see right here. Notice that REITs, consumer staples, and healthcare, those are defensive areas of the market. They were down there at the bottom. So based upon what I saw today, I doubt there's going to be a big movement out of the staples or healthcare, because both of those kind of just had average, if not slightly underperforming days today. But real estate was a big outperformer today. So next week, I'm going to be curious if real estate can make its way up to 8 or 7. And with utilities, I'm going to be curious if they can crack into the top 4 once again. This will all, of course, be dictated by what happens on Wednesday, Thursday, and Friday this week, which at this point is unknown. Remember, this is an options expiration week as well for the month of November. So that could inject a bit more volatility depending upon how market makers are positioned here at the moment as well. So be on the lookout for that as we approach Friday. All right, let's get back on track with some more charts. Back over here to the Thinkorswim platform. Let's do some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And a reminder that the background colors of these miniature charts will tell us what the posture is for each of them currently. So if the current posture is positive or bullish, however you want to describe that, the background colors will be green. If the current posture is negative or bearish, the background colors will be pink. And as I explained to you, I think exactly 1 week ago, the areas that we want to be out of favor, assuming that you're a stock investor as I am, are exactly the areas that are out of favor. Remember, a week ago I was talking about how we had TNX, oil, and the US dollar as our 3 pink charts, and how that provided wind in the sails for the stock market traditionally. The stock market doesn't like rising interest rates, so it wants to see TNX rolling over. The stock market doesn't like high oil prices and inflationary pressures that will pinch profit margins. So the stock market generally likes it when oil prices are rolling over. And since most of the stocks that are of massive size in the United States are international, and many of them earning more earnings and cash flows and sales from outside the U.S. than inside the U.S., you could get away with saying the stock market doesn't like it when the US dollar is strong. And so here we are a week later, and I'm looking at those exact same 3 charts and saying, guess what? There's a reason that the stock market absolutely erupted today. The US dollar fell off of a cliff. I mean, this is unbelievable. Remember, the US dollar is one of the most liquid asset classes on planet Earth. It was down 1.58% today. So I saw a headline on Twitter the other day suggesting that the highest percentage of Americans were planning to travel overseas in the coming year. I think it was something like 24%. I'm thinking, must be nice. I need to take an international vacation one of these years again. But too much fun around here, staring at the stock market. But for those of you that do have the good pleasure of traveling internationally here in the coming year, you might not have liked today's move because the purchasing power of the US dollar just went down in a big way here today. But for the rest of us that use the US dollar as a way to gauge how we can perform as stock investors, we should be celebrating this. This is a good thing for us, all else being equal. If you own stocks like McDonald's or Coca-Cola or those types of, Walmart, multinational company, even the big tech stocks, in many cases earn more outside the U.S. than they do inside the U.S. So yes, they are domiciled here. Yes, they are oftentimes taxed here, but their operations are global. And so like an international stock, many of those multinationals that are headquartered in the U.S. like to see the dollar down. And boy, oh boy, did we get it today. This is one of the bigger moves lower in the U.S. dollar. The oil prices were down just a touch, but it wasn't dramatic. They were down 0.32%. But as I mentioned before, one of the big drivers of today's price activity was what was going on with interest rates. You can see how dramatic that move is right there. Let me right-click and maximize this so you can kind of get the sense of how dramatic today's candle was on interest rates. It's probably the biggest one on the board. The only other one that I can eyeball that looks somewhat similar to it is this one. And, unless it's an optical illusion, I'm pretty sure that today was a bigger move than this one back here. So in other words, this was likely the biggest down move in interest rates today that we've seen in at least 3 months. And remember, we've been spending considerable time below the 30-day moving average on interest rates. So this is not some sort of a new piece of information today. It's a continuation of what we've already known. Remember, we talked about how the 10-year had hit 5%. I remember the conversation distinctly with you guys here in this audience, because I remember saying it's weird because on the Thinkorswim platform it looked like it was like 1 basis point off of 5%, but on CNBC they were announcing that it was actually touching 5%. Either way, whether it was 4.99% or 5%, the point is the market rejected those numbers. It's a big round number. And I remember making comments at that time that this market has the potential to make a move assuming that interest rates do not breach 5%, especially knowing that we were coming into a more bullish time of the year as November, December, and January traditionally are. So it's interesting now looking back upon those comments where we now know with the certainty of 2020 hindsight in what has happened since then, that interest rates have not breached 5%, at least on the 10-year, right? The shorter term interest rates have. But what the market is caring about in this case is the 10-year. And the 10-year, after touching it for that one brief day, moment in time, it has not made an attempt to get through there at all once again. So that has been the wind in the sails of the stock market here since then. And so those 3 charts remain strongly bearish as they were a week ago. Joining them is gold. Now, gold does not look like these other 3 charts in my eyes. First of all, you'll notice that the background color on gold is light pink, not dark pink like the other 3. So that signifies that we have what is referred to as a weakly bearish posture, not a strongly bearish posture like the other 3. In addition to that, it's the only one of those bottom rung charts right there where price is above a rising moving average. You actually had a pretty nice rally out of gold today. Remember, that happens quite a bit when the dollar falls. All else being equal, since gold is priced in dollars, when the dollar has a big sell-off, gold prices themselves can go higher. So it's good to see that that relationship is still connected. Today was a decent bounce day up and off of a rising 30-day moving average here for gold. And so I wouldn't be surprised at all if the background color switches back to green on gold as soon as perhaps tomorrow. Let me right click and maximize this. You can kind of see that the green line is flatlined. It's not quite as flat as I thought I would see when I blew this up into a zoomed in version. There's still a distinctive downward tilt to that green line right there, but let's call it a couple of days. If we get gold prices up tomorrow and the next day, I do think that this green line will be pulled higher, and therefore the background color of the chart will be green at that time as well. Now, obviously, if gold sells off in a major way tomorrow or the next day, then all bets are off. But right now, it's in the position to be joining all these other green charts, whereas these other 3 charts on the bottom rung, they're in much more of a house of pain right now, which is a good thing for the rest of us who want to see stock prices going up. So all those other charts, as I just mentioned, are with that dark green background color. Bitcoin had a quiet day today, but continues to basically hang out around 35,000. Of course, that has been an asset class that was breaking out even before stocks. It has basically held the line of that big move that it had here a couple of weeks ago. High yield bonds up over 1% today. That's a dramatic move for junk bonds right there. Notice that high yield bonds all of a sudden are much closer to their 3-month highs than their 3-month lows. We can't make that claim on U.S. government bonds yet, at least long-term bonds. But, you could make the case for foreign bonds being that way, right? Both foreign bonds and high-yield bonds are closer to their 3-month highs than their 3-month lows. So it's almost like we've got a stealth bull market trying to be initiated in the bond market. We're not there yet, right? These things come in fits and starts as well, but there's progress being made in the bond market right now. So keep your eye on that possibility. Remember, the bond market is basically in the midst of its worst back-to-back calendar year in history. So there could be a lot of meat on that bone, so to speak, right? If we truly are seeing a reversal in order to kind of normalize the selling effect of the last couple of years, you could see a bigger chunk of outperformance out of the bond market under the right conditions here in the coming year than what you had previously thought was possible, right? A lot of people didn't think it was possible to see the bond market fall as spectacularly as it has in the last couple of years. So there's always the possibility that the pendulum swung too far. In order to kind of equalize that and balance that out, you might need that pendulum to swing back a fair bit as well. And if that's the case, there could be some decent gains awaiting folks that are willing to kind of wade into that portion of the market. So TLT, long-term U.S. Treasuries, were up 2.27% today, actually beating the S&P 500. On that top rung, no surprise, foreign stocks did awfully well today, right? This is a day where the U.S. dollar got absolutely demolished, so we should assume that foreign assets could outperform U.S. assets. So EFA, which is foreign developed stocks, were up 2.55%, and EEM, which is foreign emerging market stocks, were up 2.66%. Both of those easily beating the 1.9% increase out of the S&P 500. Let's go ahead and take a look at our sectors now, and that will be chart 5C. And as I alluded to earlier, I'm not surprised now that we have the actual evidence that utilities and REITs were our leaders today. That was pretty obvious to me when I was looking at the heat map earlier. Now we can confirm it with our own two eyes. We had dramatic movements out of REITs and utilities today. Now do keep in mind, many of them are down significantly year to date. So it's kind of the phenomenon of, throw something off of a skyscraper and it's going to bounce. Let's say you have a bouncy ball you throw off of the Empire State Building. That ball is likely to bounce much higher off of the pavement than if you lived in a second-story building in the same city and bounced the bouncy ball off of your second-story building. It's going to bounce off the pavement, but not nearly as high as one that has a lot more gravity and physics kind of working towards that bounce there. So that's part of the story with utilities and REITs. They have done poorly this year, so when we finally had a catalyst to get them going in the opposite direction, they're going to have an exaggerated movement, and that's what we have here. The utilities were up 3.99% today. Yes, you heard that right. The utilities, the boring old utilities, up 4% in a single day, meaning that many of them were up a lot more than that. Some of them were down or were up a little less than that, but it averaged out at a 4% move for utilities. Real estate was even better. They were the leading sector today, at least from a market cap weighted perspective. Real estate was up 5.4% today. I noticed that one of the REITs that is out here headquartered in Utah, where David and I live, is Extra Space Storage. That was one of the best performing stocks in the entire S&P 500 today. It was up over 10%, probably on no news, just the fact that REITs themselves were finally getting going again, and some of them have been beaten up so badly that their snapback response is really, really aggressive. So those two interest rate sensitive areas of the market were the ones that benefited the most for the big drop in interest rates that we had talked about just a moment ago. The underperforming area of the market also is not particularly surprising to me based upon our conversation earlier in the video on our heat map. Healthcare was only up 0.68% today. Now, they were still up, so that's good, right? All of our sectors were up today, so it was a clean sweep from that perspective. But healthcare was up the least amount of all of these 11 different sectors. Healthcare, of course, was weighed down today by selling in some of those areas like Eli Lilly and United Healthcare and AbbVie that I had mentioned before, right? So while there were lots of small healthcare companies that were up a lot, it's the large ones that were kind of the cold, wet blanket here today that kind of, stomped out any chance of an aggressive rally like we saw with the utilities and the REITs. So healthcare underperformed today. Energy also underperformed today. Energy was up 0.89%. And again, remember what we just looked at there a second ago with oil prices. Oil prices were down in the dumps. So no surprise that oil companies didn't have the same type of mojo as some of these other sectors that were out there. But some really nice moves all over the place here today. In fact, all of a sudden, this is the first time I've been able to say this in quite some time, only one sector has a red 30-day moving average, and that is energy. Notice the moving average color is red, telling us that price is below a falling 30-day moving average. All the rest of the moving averages that you see in front of you are green, and that even includes healthcare. So while we have a bearish intermediate posture, according to the market forecast technical indicator, that's what's painting the background color pink, the moving average color itself, and I know that's probably hard to see for those of you that are watching this YouTube video on a cell phone, but if I zoom in here, you can see now that even healthcare has a green moving average right now. So by the slimmest of margins, we are trading above a rising moving average on healthcare as well. That's obviously quite precarious. That could very well go away as soon as tomorrow for all I know. But at least for one very small sliver of time, we have 10 out of 11 sectors trading above their rising 30-day moving averages. Remember, it was just 3 weeks ago we were talking about the pain train that was happening within the stock market. And just like that, like the snap of the fingers, things have improved dramatically from a bullish perspective. Many of these sectors close to, if not at, 3-month highs here. That includes technology. That's a new 3-month high. That includes communications, a new 3-month high. We're getting close to it on financials as well. So, those are some of the leading areas from a market cap perspective when you're looking back just not only today, but looking back multiple weeks. So we've got plenty of leadership out there. Communications is an area that we concentrated on in my Monday top-down trend trading class there. So it's good to see it continuing its breakout there, because there's always the possibility where communications ended yesterday would have been at a resistance point from some of these other selling areas previous in the 3-month area there. But today, it was very much decided by the powers that be that they were not only going to go through those prior resistance areas, but literally gap through it, right? The opening gap to start right there. So that was kind of fascinating as well. All right, let's go ahead and now get into our trade application example for the day. Remember, I do these trade application examples while the stock market is still open, and that gives me the benefit of being able to pass that information along to our premium members who gain access to our private Telegram channel. Not to suggest that our premium members should always be taking the trades or anything along those lines, but just gives them an information advantage and gives them a heads up as to what we'll be talking about in the video, and they can choose to do whatever they want with that information. So today's trade is a bullish trade, and it is on a utility. Of course, utility is one of the breakout areas of the market today, and that is ticker symbol ED. This is Con Ed. Every time I hear about Con Ed, I want to think about Ghostbusters, right? I suppose I'm probably somewhat alone in that regard, but for whatever reason, I'm a child of the 80s, and Ghostbusters was big back then. It's kind of coming back a little bit here, but I don't think the redo videos that have been done recently have been quite as good. Nonetheless, for whatever reason, that was probably my first interaction with hearing about Con Ed, remembering those electricity workers in New York City while the big blob was walking around there. Well, anyway, Con Ed is perceived as a fairly high quality utility. I wouldn't say it's amongst the absolute best, but it is notorious in one regard. It is one of just, I think, 3 utilities that are on the Dividend Aristocrat list with a very long history of growing the dividend each and every year, usually by very small amounts. So this is not one of those epic dividend growth stocks, but nonetheless consistently raising shareholder pay for many, many decades at this point. Today's trade, of course, doesn't really have anything to do with dividends, as is oftentimes the case with these trade applications. They are generally geared more towards those of you who consider yourself more short-term oriented. And so I did a bullish swing trade on Con Ed here today. And the reason that I chose this one is because we had a bit of a bullish near-term divergence signal that appeared. You have a trough in the blue near-term line on the market forecast down below here on November 8th. You have a follow-up trough here on November 13th that is obviously higher, right? You had the one trough that was in the lower reversal zone. The second trough was way up there, in fact, close to the midpoint of the neutral white zone there. Well, when those 2 points were taking place, it was associated with this candle and this candle. Remember, it's the lower right-hand corners of the filled-in red portions of the candle that will tell you what the closing prices were. So the closing price on this candle was right here that I'm pointing at, and the closing price on this candle was slightly lower than that. So you had a deterioration in price. At the same time, you saw an improvement in the underlying indicator. So that was happening even before today, and today helps kind of confirm that there was something to that information that was being supplied by the blue near-term line here. Today, obviously a powerful day, just like we saw with many utility companies, where Con Ed basically closed at the highs of the day, and in doing so achieved what we would refer to as a hold pattern, or a close above the high of the low day. Notice that the background color of the chart changed from pink to blue, telling us that we now have a bullish near-term posture. You'll also notice that the green line is rising. It's hard to make that out with the naked eye here. Remember, you can always read that within the labels themselves as well. So the intermediate green line is at 68 and rising right now, which means that we do have a bullish posture from an intermediate perspective in addition to a bullish posture from a near-term perspective here. They did pay their dividend today, so that's already been kind of sorted through there with price activity, so it should trade more organically from this point forward. And you can kind of see where I've kind of left my levels here. In other words, I put my stop loss a couple of pennies below the low of this candle on November 8th, and we're shooting for a 1-for-1 reward risk ratio on this swing trade, like I oftentimes do, which means that our price target is up here just a shade under 93. So it does not require us to break out to new multi-month highs. It just requires us to get to somewhere around the highs of this candle on November 3rd and this candle over here on September 15th. So if this momentum we saw out of the utilities continues today, there's a decent chance that we can achieve our goals with this trade. If, on the other hand, today ultimately is represented as a head fake and utilities and REITs roll over once again, then of course we will be stopped out, and we at least know where our risk is here with this particular trade. So that's what I had for you here tonight. I hope you enjoyed the video. If you did, I ask one simple request out of you. Take 5 seconds out of your day and click like for us there on Twitter. Remember, this will be pinned to the top of my timeline. You can also find the tweet in question by looking at the description area underneath the YouTube video for those of you that watch the video there. You can also find the tweet in question in the Twitter widget underneath the video for those of you that watch it on the Market Scholars website. And then last but not least, we also have it hyperlinked within the Twitter icon on the emails that we send you guys. So any one of those 4 ways, whatever it is your easiest and most convenient, will get you done in adding to the tally. Again, our goal is always to get to triple digits on the like, and as long as you guys can get me there by the time I'm scheduled to do the video again on Thursday, I'll be more than happy to give you another hour-long presentation as I did here tonight. On the other hand, if you prefer the shorter videos, then don't click like, and if we're under 100 likes, I'll just keep it to a 15-minute maximum video there for you on Thursday. So we'll let you guys decide there collectively. Whatever it is that you do decide, I appreciate you checking out tonight's video. Quite the historic day here we just experienced, and hopefully cause for jubilation for many of your longer-term portfolios especially. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.